In this video, we got a pretty great topic. We're going to look at delta neutral trading strategies. So let's understand first the concept of delta. Delta just measures an option's price sensitivity to changes in the underlying asset, whatever it is. So it tells us how much of an option's price may change for a dollar move in the stock price, the underlying. So for call options, delta ranges between 0 and 1. A higher delta is going to indicate a higher likelihood of finishing in the money. The flip side of that, put options have negative deltas. That indicates an opposite relationship with the stock. Let's take a look at two main types of delta neutral trades, the short and the long straddle. So first, the short straddle, this just involves selling both a call option and a put option at the same strike price. When you do this, you collect a premium up front. That's your income. The short straddle works best when the trader expects the underlying asset is going to have low volatility. It's going to remain within a specific price range. So let's say you sell a call option and a put option on a stock. The strike price is $50. So if that stock price stays around $50 until expiration, both options are going to expire worthless. You keep the premium, that's your income. The long straddle, you're going to buy a call option and a put option at the same strike. When you use this strategy, you expect some price volatility in the asset. So the goal is to profit from a large price move in either direction. So let's say you buy a call option and a put option. The strike price is 100. If that stock price experiences a big increase or a decrease, the value of one of these options is going to increase, and that's going to offset the loss in the other option. This strategy allows you to benefit from significant price movement. So now let's take a look at a more advanced delta neutral trading strategy. And this one sets up a position. It's not sensitive to small movements in the price of the asset, right? This is going to be achieved by balancing positive and negative deltas. So first thing, we're going to sell an out of the money put. So you sell a put option where the strike price is below the current market price of the underlying asset. You're going to sell the underlying asset. The part of the strategy involves selling the stock that the options are based on. This is advanced. So the primary objective here is to exploit short-term volatility in the market. When you create a delta neutral position, you look to profit from changes and other factors like implied volatility or time decay. You're not really concerned with the directional movements in the stock. So let's talk about XYZ. It's currently trading at $100. So you sell an out-of-the-money put. So you sell put options with a strike price of $95. This means you're expecting the stock price to stay above $95, and you get a premium for that. You sell the underlying stock. So to balance the positive delta from the sold puts, you also sell shares of XYZ. This creates a negative delta that offsets the positive delta from the puts. So let's assume XYZ, the stock, that price fluctuates slightly, but it stays around $100. Your sold puts are out of the money and may expire worthless. You keep that premium. Meanwhile, the impact of the stock price movement on your position is minimal because your overall delta is neutral. So again, this strategy is not about profiting from a significant move in stock, right? It's about capitalizing on other factors, the time decay, the implied volatility changes. And if the stock price remains relatively stable or moves within a narrow range, you profit from the premiums collected from the sold option. That's an advanced strategy. So now you have a bit of an understanding of delta neutral strategies, right? So now it's time to start practicing these, right? So start small and just gradually increase your exposure when you gain confidence, right? Only you know when you're ready for that. Have you ever used delta neutral? If you have, pop that information in the comments below. And listen, if this just confused you, that's okay. If you reach out to Mike at NetPicks.com, this is our in-house options guru. Any questions about options trading or how you can get started with options, this is the guy you want to speak with, right? Drop him an email, Mike at NetPicks.com. Thanks for joining us today. If you found this video helpful, make sure you like, make sure you subscribe, and we will talk to you soon.